Hello and welcome to Advanced Charting Techniques, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. For those of you who are joining us for the first time, welcome. Thanks for being here. If you're here on a regular basis, we're glad to have you back and glad to have you here on this holiday Friday weekend. Now, I've got my good friend John McNichol out there in the chat helping to answer questions. He's a 20-plus year veteran of the financial markets as well as other things. And he's a good friend and a great resource in this arena as well as all things trading. So we're glad to have him here with us as well. Participate in the chat. Ask your questions. Leave your comments. Be a part of the community. If you're watching this in the recorded version, participate by leaving comments in the comment section. We appreciate you doing that as well. A couple of things that I wanted to talk about today, and this is an opportunity in teaching this class for me to address a question that I get on a pretty regular basis, whether it's at a workshop or whether it's in a webcast or after a webcast or on X. By the way, you can follow me on X at Ben Watson CS. You can follow John on X at John McNichol CS. You can follow all of our education coaches the same way, same kind of naming convention. But this is a common question that comes up. What is the best technical indicator to use? Or the variation that comes up of that question, why don't you use this technical indicator? Why are you using that technical indicator? So we're going to try to address some of that mythology in this discussion today. As we get into this discussion of advanced charting techniques, we're going to do some comparisons, and I'm going to show you a way in which we can maybe put some objective analysis to that idea of what's the best, right? Because as Gaston says, don't I deserve the best? Let's get into the discussion here really quickly. A couple of quick housekeeping items as we get started. Remember, everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular strategy or chart pattern or technical indicator or investment strategy or symbol. If we talk about options, which I don't think we will in this particular discussion, but if that concept does come up, remember that options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that there is no guarantee when we use things like stop orders that a stop order will fill at a specific price, or that it'll fill at all if it's a stop limit order. Now, we're going to use technical analysis. We're going to use a breakdown of technical analysis in this discussion, but it's important to remember that technical analysis is not a guarantee of future success. It is theoretical in nature, and because of that, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be using and focusing on the Thinkorswim desktop software platform today, specifically the paper money version of that platform. The paper money version is a great learning environment. It's a great sandbox. There are some things, however, that the paper money version of the Thinkorswim desktop platform does not do. It does not allow us to apply studies in scans, and it doesn't do things with short options that we might be familiar with. And it more often than not will fill orders at mid-market as opposed to closer to the bid or closer to the ask. So you may get some unrealistic fills. And as we do some of the things we're going to talk about today, that may have an impact on your calculations, especially as things get a little more granular. You'll see what I mean when we get into this discussion. Now, we're going to be talking about a little bit of back testing in this discussion today. So I have to, in full disclosure, say this. Backtesting is not a guarantee of future success. Just because something has worked a particular way in the past does not mean that it will work that way into the future. So backtesting is not a guarantee. It is simply an objective way to look at a set of circumstances. Now, for the sake of simplicity, I'm going to read this one. For the sake of simplicity, these examples we will talk about today do not take into consideration transaction costs or tax considerations or margin implications, which are factors that may significantly affect the economic consequences of some of the issues that we talk about, especially when we start talking about getting filled and liquidity. So we'll have a discussion about that as we get into this process. But I just want to make sure that we are properly warned as we go into this discussion in advanced charting techniques. So we're going to talk about technical patterns. We're going to talk about the pros and cons of some of those technical patterns, and we're going to look at some examples on the chart. So I'm going to shift my focus over to the Thinkorswim desktop software platform. And as I do that, it's a good opportunity for me to remind you to click on that subscribe button down at the bottom of the page. That subscribe button connects you to the Trader Talks webcasts channel and the community that has built up around that channel. And as we do that, you click on that subscription. It's at no cost to you. That's going to help other people find this content as well. And if you like what you see in this discussion today, click on the like button as well. That's going to help. That's going to help other people find this also. And it's also going to let us know that there are things that you like in this webcast. So let's take a look at what's going on in the market really quickly. Just kind of set our stage. This is not the focus of our discussion is in terms of what is happening specifically, but I wanted to set the stage. We've got a little bit of a bounce on the SPX above the 200 period moving average, kind of bouncing off of that 200 period moving average after a gap down, a little bit of gap down rally today on the SPX. Again, a little bit of a gap down rally on the NASDAQ, but to a higher level and well above the 200 period moving average here, the 50 period moving average turning up a little bit. And the Russell 2000 gap down and rally today, almost down to testing the 50 period simple moving average in this particular case, well below the 200 period moving average. So of the three of these indexes has not really resumed that upward trend. But the reason I wanted to get a sense here is I want to kind of get a sense of what's going on overall. You notice that I've got a couple of different moving averages on this particular chart. So if we're going to start with kind of this discussion of what technical indicator, what variation of a technical indicator is quote better than others, than another, then let's start and use this and kind of extrapolate from the basics, right? If trend is a confirmation of directional price movement, right? We use things like moving averages as a means to express the direction and in some cases the duration of that existent trend. So we can start with this discussion of moving average. So what I'm going to do is I'm going to shift my grid away from this index grid where I already have those pre-built here. And I'm going to go to my single grid chart, which is kind of my sandbox. If you've been in one of my webcasts recently, you know this is the sandbox that I kind of play in here on the charts. It's kind of a basic chart. It's just a 1 year daily candle chart. We can change the symbol. We can even put SPX on here, but it's where I draw lines and I have kind of that laboratory, if you will. I'm going to come up here to the Flask icon. And I'm going to take off this RSI indicator on there, which is perhaps the subject of another day. I know that Cameron has talked about the RSI on a number of different occasions. I've talked about the RSI on a number of different occasions. But all I've got right now is price action. And price action doing what price action is doing. These are individual candles. Green candles are up days, red candles are down days. And we can see that right now, absent, if we were to clean this up, absent any moving averages or anything else on here, we can kind of see what that trend progression has been. If we think about what maybe our trend or our time frame definitions are here, short-term trend might be days to weeks, intermediate term trend in this case might be weeks to months, and longer term trend might be months to years. So we could argue that the market is in a long-term uptrend. Still is, right? Left-hand side to right-hand side, still making higher highs and higher lows for the most part. Intermediate term, it's certainly sideways, maybe up. Short term, if we look at the last few days, it's in a downward trend, right? And we could express these different trends. Now that we kind of have that baseline understanding, we could express these different trends with different periods of moving averages on the chart. And if you've been to one of the live workshops, you know that this is kind of the progression that we go through. Now we start to add moving averages onto this chart. So we can come up and we can look at a set here and we can say, fine, let's put on here, say for instance, a 10, 50, and 200 period simple moving average. I'm just going to put that on here. We're going to click on use that set, 10, 50, 200 period moving average, click on apply and okay. So now we've got a fast moving average, that's the 10 period, that's the red moving average. I've got a intermediate moving average, that's the 50 period moving average. And I've got a long-term moving average. That is the 200 period moving average. And you can kind of see the relationship. So we can make trading decisions based on this, but these are simple moving averages. And every time I pop up this particular set of tools, these simple moving averages, do you know what the inevitable question is that comes up? You know what the inevitable question is? Why are you using a simple moving average? Shouldn't you be using an exponential or a Hull or a displaced or a triangular or a whatever variation or flavor of moving average that somebody has been sold and bought a book about and is paying for a subscription or a website or a newsletter or something so that they have to justify their monetary spend? And my answer is this. Well, sometimes, you have to make a decision. What's better? What does it mean to be better? So we need to make an objective decision here. So now that we kind of have that understanding of what those moving averages look like, what I'm going to do really quickly is I'm going to take a look at each one of these individually to a certain extent. I'm going to go back to my Flask icon and I'm going to close the eyeball on my on my long-term and my intermediate term moving averages. I'm going to click apply and okay. And now I've got my 10-day, in this case, 10 days, because these are days on the chart, but this would be a 10 period moving average. If these were weekly candles, this would be 10 week. And if you've been around technical analysis for a while, you know that aggregation period changes with the periodicity of the chart. So you change this to a weekly chart, this is going to be 10-week moving average. If you change it to a 5-minute chart, this is going to be a 10 5-minute moving average, essentially. And we can see what's happened here, that the price of the index has dropped below that 10-period moving average. It moved above the 10-period moving average back here. And so from the standpoint of trade entry and exit, we could just simply say, if we were looking at this as a trading indicator, right, a means for entering and exiting trades, we could enter a trade. Now, SPX, remember, is an index. It's not a tradable instrument. So we'd have to trade something else, either the futures contract or the ETF if we were going to trade this exact performance. We'll look at another symbol here in just a second. But if our entry was price moving above the 10-period moving average, meaning it's moving faster than its last 2 weeks of trading days, then that would be an entry signal right here. And depending on whether you use some kind of time confirmation rule, we're just going to simply say cross above, entry, cross below, exit, right? That's our objective signal here. So price moving above the 10-period moving average, entry signal, price moving below. Now, that's not a recommendation. That is simply an illustration of how you might logically in your head structure an entry or an exit signal. If price moves above the 10-period moving average, get into the trade. Price moves below, get out of the trade. And you can see that in that period of time, we would have taken this trade from right about here to here and then gotten out as this was starting to move to the downside. Great, cool, that works fine. One of the things you run into is that when it's moving up and down or moving in a trend, great, that works pretty well. But when that trend is moving sideways, like this period of time right here, you had above, below, above, below, above, below, above, below. And so you get whipsawed in and out of that trade, right? And so then the tendency is, okay, let's strengthen or let's lengthen out our indicator and let's take longer time frame signals or longer wavelength signals. So let's go to the Flask icon up here. We'll close the eyeball on the 10-period moving average. We'll open the eyeball on the 50-period moving average. We'll click on apply and okay. We'll say, all right, fine. Now we're going to take a trade when the price goes above the 50-period moving average, and we're not going to get out until it goes below the 50-period moving average. So in this particular case, above, and we're still in, right? We're not out yet. But you come back over here, and there's this long period of time where we are out. And if you come back into this sideways time frame right here, you can see here we were below, so we were out, above, so we were in, below, so we were out, above, so we were in, below, so we were out. So once again, when the price is going sideways, we get whipsawed in and out. So technical indicators like moving averages sometimes suffer from some weaknesses, especially around sideways or churning trends or oscillating trends where you'll get whipsaws, even on a longer term moving average. So yeah, we can take those off. Sure, Josie, absolutely. Let's do this. I'm going to create a new drawing set. We'll create a new drawing set. We'll call this ADV clean. And we'll take those off. There we go. So that's the cool thing about this chart, Josie, is that you can take those lines off whenever you want to and put them back whenever you want to, right? So now we've got that price moving above and below. Now this is the longer term chart. And we say, okay, fine. Well, I'm still getting whipsawed in and out, right? I'm still getting whipsawed in and out. So maybe I slow this signal down even a little bit more. So I'm going to come back over here. I'm going to close the eyeball on the 50. I'm going to open the eyeball on the 200, click on OK, and we say, fine. Above, I'm in. Below, I'm out. So here we have a situation where we got out back here. We're out, out, out. Now back in, and maybe approaching that period where we're out again. So there is that possibility again, even when in that longer term moving average, we can get whipsawed in and out. But the number of times that we get whipsawed in and out, lots less. The number of times that we take entries and exits, also lots less. So faster moving average, not necessarily better. It just means that we're going to get more signals. So that answers kind of the first question of time frame, right? What time frame is best? Well, the answer is there isn't one best time frame because it depends on A, what you're trying to do, and B, what the signal is that you're trying to capture. So keep that in mind. So I wanted to do that first of all and kind of make that objective analysis. Now, if you don't believe me, I'm going to show you a quick tool that we can use to be able to make this assessment maybe even a little bit more objective, less my opinions and subjectivity and more objective based on the numbers. So in order to do that, I'm actually going to expand the length of this chart, right? I'm going to expand the length of this chart, and we're going to use a different symbol because we can't trade the SPX. So I'm going to make this a 2-year, so I'm going to go to my time frame, 2-year daily chart. And the reason I'm doing that is I want to have enough signals, enough trade inputs for this to be somewhat statistically significant. So if I'm using that 200 period moving average in this case, right? The 200 period simple moving average, and I say above I'm in, below I'm out. I got in here, in, out, down here when it's crossing, maybe in and then whipsawed back out, and then in, and I'm still in. So I had maybe 3, maybe 4 trades in this particular circumstance, right? Not a lot of activity, but capturing the majority of the trend, maybe getting out and giving back a little bit at the top, certainly giving back a little bit at the bottom, and with that possibility when it's going sideways of still getting whipsawed in and out. So then the next question would be, well, wait a second, this is a simple moving average. Why not use an exponential moving average? So you know what I'm going to do is I'm going to come back up here to the Flask icon, and I'm going to go down here to the chart studies over on the left-hand side, and I'm going to type in EXP, exponential moving average, or moving average exponential. And I'm going to put in a moving average exponential, go to my gear icon. I'm going to make this one 200 periods, and we'll make this a different color just so that we know the difference. I'm going to make this one kind of that red color, and I'm going to make that 4 points wide so that I can see it. Now, this is an exponential moving average. I'm going to click on OK and apply and OK. And you notice that, boy, that really didn't change the number of signals that I've taken, did it? So, in here, maybe I got a little bit whipside there. Maybe I got whipside for sure here. And maybe I got whipside for here, sure. So looking just at the two of these by themselves, I can see that maybe that simple moving average, because it's a little bit more smooth and not as weighted towards that recent price action, in fact, kept me out of a couple of whipsaws. So the faster signal potentially that an exponential moving average could provide maybe isn't always the best thing, because it adds to the possibility of some false signals or getting whipsawed in and out. That's a common assessment or a common relationship. So you can kind of see the difference between these two. Now, what I want to do, now that we've got that idea, and if we were to go through those separate time frames, the shorter time frames, we'd see the same type of relationship. You'd see the same type of thing. But I'm kind of building here on these building blocks, because now what I want to do is I want to clear these off. I'm going to take these off of the chart, and we're just going to look at a chart. So I'm going to look at two charts here. The first one that I'm going to look at is one that is trending, that's replicating this movement fairly closely, and that is GE. Take a look at GE. Now, the reason that we're using this, and you can do your own stock selection, but the reason that I'm doing this is that for the most part, the trend has been up. It's had some sideways periods, so we're going to see some churn potentially, but it's generally been in an uptrend. So if I were to come back over here to the chart and I were to say, all right, fine, SIMP, simple moving average, and we'll put that simple moving average on here. And actually, let's just do this. Let's go to our set. And I know that I've got my 10/5200 simple moving average here. I'm just going to use that set, and I'll turn off those eyeballs respectively, but I'll click on apply and OK, and you can kind of see what's going on, right? You can see where this price is relative to those moving averages, and we can use the same kind of logic: above, in, below, out. And we're probably still in that shorter term trend, we're still in the intermediate term trend, and we're still in the longer term trend type of trade from those entry signals, right? So now that we kind of have that idea, we can see what that's doing. Now what I want to do is I want to compare some actual numbers. And there's a process that we can use here on the Thinkorswim platform to do that. So I'm going to hide these. I'm going to close the eyeballs on those. And you happen to notice, and I don't know if any of you have ever explored this. I know Cameron has talked about this once or twice before in this particular webcast, but these strategies, and I know Michael Fairborn has talked about it quite a bit in his ThinkScript webcast, because I know I've talked about it in the ThinkScript webcast, is using these strategies. So what I'm going to do is I'm going to come over to these strategies, and I'm going to scroll down through these strategies, and there's a bunch of those that are pre-built. By the way, you can also build your own custom strategy. But what these strategies do is they apply technical price patterns or indicators or circumstances and allow us to do a little bit of back testing. So what I'm going to scroll down to is this one that says moving average strategy. And I'm going to click on that little question mark there. And I'm going to say the moving average strategy adds buy and sell orders onto the chart upon crossovers of price with its moving average. And by default, it uses a simple moving average. So what we're going to do is we're going to apply that one, and I'm going to add that selected strategy to this discussion. So by default, here's what it comes up with, right? Is simple moving average, 15-period moving average. What I'm going to do is I'm going to come in here, I'm going to go to the gear icon, and I'm going to make this a, let's go back to our shorter term time frame, which is our 10-period moving average on our other set of moving averages. Simple moving average, 10-period moving average. And what I'm going to do to apply this to the chart is I'm going to come over here to the moving average LE, long entry, SE, short entry. So here's what I'm going to do. When I get a long entry signal, which would be price moving from below to above a moving average, I'm going to initiate an order to open a trade. And when it gets to the moving average strategy short entry, I'm not going to enter a short position. So I'm not going to go long and short because that would entail margin costs and shorting the stock and things like that. But what I'm going to do is I'm going to go here to close. So moving average long entry, open, moving average short entry to close. That's what this back testing process is going to do. And I'm going to click on OK. And we're going to open up the eyeball for that 10 period moving average, click on apply and OK. Holy cow. We've got a whole bunch of entries into this trade, right? So I'm going to kind of zoom in so you can see what's happening here. So what's going to happen is every time there is a move above that 10 period moving average, every time there's a close above that 10 period moving average, it's going to add an entry into the trade, right? And every time it moves below or closes below, we're going to get an exit out of the trade, right? So Josh is already thinking, I know the gears are already turning here. Josh saying, can we automate trading using this strategy? And there are ways to do that, but they are not completely evident. There's a great way to be able to use this as a means to initiate a back testing process, but in terms of putting in an order, you've got to go through some other steps and some other applications. So there is, but yes, but not a simple way to do that. So watch what we're going to do now. In order to see what's objectively kind of put some numbers to this, I'm going to zoom out and I'm going to say, look, I've got a lot of trades here. And I notice that periods of time where it's going sideways, a lot of whipsaws. When it's trending, not so much, right? So what I'm going to do right now is I'm going to come over here to wherever I see one of those labels, and I'm going to right click. And you see this little button right here that says show report? I'm going to click on that show report, and it's going to create this strategy report for the time frame that I'm showing on my chart, this 2-year time frame. And I'm going to come down here and I'm going to kind of scroll down through this list. So this is telling me, going back to the beginning of the chart, there was an initial entry into the trade of 100 shares at a price of $82.22. That initial entry was 530.23, 100 shares long. And then it was sold at a price of $80.86 on 531. So the next day it got whipsawed back out, and then we took a loss on that trade, right? And yes, and you can do that, Chris. I'm going to kind of, you're absolutely right. That's the next level. I'm going to keep this simple for the moment, right? Because I'm primarily focusing on the division of these two different processes, right? Okay, so let's scroll down, and you can see that out of this particular strategy, it generated 83 trades. And the max trade gain was 3,543. The total, when you take out the losses, was 2,247. Now, the other thing that I want to say, and I made mention of this when we started, was that this does not account for transaction costs, slippage, because this assumes getting filled at the mark, the midpoint between the current bid and the ask for each of these prices. So that happens in paper money, not always in live trading. So be aware of that. These results will be different. These are theoretical in nature. So we had 41 trades, essentially 83 or 43 orders, 83 trades were still in at this point. We're still long in this particular case, right? So here's what I'm going to say. If we were to say this, total profit and loss for this trade, $2,247. I'm going to close that. I'm going to open up my Scratchpad over here, and we're going to say this. We're going to say GE10 SMA was 2,247. That was our gain in this trade, right? 2,247 was our gain. That's for a single moving average crossover. So now let's try GE with the 10 period exponential moving average, EMA, and we'll see what that gain was. So we can do that really fast. You can see where what I'm getting to here in this particular case. I'm getting to the process of you now understanding how you can test right? I'm demonstrating and illustrating this, but I'm getting you to the point where you can then take this information and objectively run your own tests, right? Do your own research and prove what is the best strategy for you, because it's not up to me, it's not up to John, it's not up to Cameron, it's not up to James Boyd. You do your own research. So I'm going to click on that flask icon, and we're going to change this moving average strategy. I'm going to go to my gear icon, and I'm going to change this moving average type from simple to go exponential. And we'll click on OK and apply and OK. Now, objectively, I'm not seeing any real difference here, but what I'm going to do is I'm going to right click and I'm going to go to show report, and I'm going to say, all right, now we know that this is a 10 period exponential moving average. We know that we had about 80 orders. We had about 41 trades on the simple. Let's see how we do. If we scroll down here, we have a few more entries. We have 45 total trades, and we have a lower total profit and loss. Anybody want to guess why we have a lower total profit and loss? We had more trades, but lower profit and loss on this trade. We had 1406 versus 22. Objectively, same time frame. The only thing that changed was this was a exponential. This is an exponential moving average versus a simple moving average on the previous one. Nothing else changed in our filter. Oh, we probably got whipsawed in and out of a few trades here along the way, because that exponential more reflective of current price action. And when we're in a sideways trend, we got whipsawed. Good job, Chris. Kevin, you got it. You nailed it. More whipsaws. So I don't know. You tell me. In that same time frame, you have a lower profit and loss. You have 10 more trades, ostensibly, more transaction costs, more grind costs. So which one is better? You choose. I don't know. So we'll put that in here, 1406. I'm going to close that one, and I'm going to bring up my, we'll just say this, okay? 1406. Now remember, this is the same time frame, this is the same circumstance, everything else, but this is theoretical, this is back testing, this is not a guarantee that one is better than the other. I'm not saying that. I'm just giving you some data for you to compare. Now, I'm going to do a really quick comparison here, just in the same time frame. I'm going to do the same thing, and let's see in a different stock, because this is the same stock. So let's do this. Let's change this to Disney. And we'll do the same time frame here. I'm going to go back to my flask icon. I'm going to change this back to simple. We'll start with simple again. We'll click on OK, apply, and OK. And we'll right click and we'll run the report. And we'll see what we get for running the report. This is this 10 period simple moving average. How many trades did we get? We'll scroll down here. We had 38 trades, and our profitability. This is a sideways, kind of a sideways oscillating stock, similar price. This is Disney, 10 period SMA, and we were at 2,861 over this time period. So now let's do Disney, 10 EMA, and we'll see what we get. So I'm going to close this. By the way, you can export these. You can build spreadsheets. Guys, I'm appealing to you data geeks here to a large degree. Those of you that are very analytical, I know that you're out there. You don't have to hide in the shadows. You can come out. This is a safe space. I'm going to change this to exponential. We're going to click on OK. We're going to click on apply and OK. And now we're going to run the report for this exponential moving average. Same time frame, same stock. Let's see what we get. Oh, 38 trades. And what was our gain in this one? It was 1,459. So simple's not so bad when you compare it apples to apples in this particular case. Two stocks, one trending, one sideways. And in both cases, the simple moving average, because of the lack of whipsaws, kind of increased the kind of objective overall gain in the trade, right? So you could go through, and again, you can iterate this as granularly as you want to. If you want to change the time frame on the indicator, again, the way that you do that, you go to the Flask icon. Here's your moving average strategy, and you use the gear icon and you change it. I'm going to throw one more in here for the purpose simply of again the exhaustive nature of exploration here, the whole moving average, which carries a lot of mythology to it. Same thing, we're going to keep the same strategy conditions the same. Long entry to open, short entry to close. So we're not going short. We're going to do the whole moving average. We're going to click on OK, and I'm going to click on apply and OK. Whole moving average. We're going to keep Disney. This is the 10-period whole moving average. We're going to keep Disney. We already know what the 10-period simple moving average for Disney is going to be. It's right there. So we can come back over here. We can right click. We can run the report. And let's see what our report results are giving us. We have using the whole moving average. Okay, this is interesting. In the whole moving average, we have double the number of trades, and we actually see a little bit of an increase in the profit and loss. Wow. Now, Chris is saying, well, the 10-period whole is much too fast. Okay. We've got a lot of whipsaws. So that may be where you start your exploration in filtering this out. So we're just going to put this in. So this is the 10 hull. And we ended up with 3,674. But we ground down a lot of that because this, again, remember, isn't taking into account transaction costs and slippage between the bid and the ask. So you can kind of see the process that we've gone through here. So is it that much better than the 10-period simple? I don't know. That has, again, up to you to answer that particular question. But now we can do some other things with this. We can start to say, okay, fine. Well, okay, that's just price moving above or below. We can get in a little bit more granular here. We can go to our Flask icon. Let's take that simple strategy off. Let's go to our strategy set and let's scroll down here and let's say, okay, what do we have? Well, let's see. We've got a moving average 2-line strategy. So this would be a typical crossover, right? And we can say, all right, fine. Let's put that on here. And let's go to that longer term. Well, I'm going to just do this. This is interesting because I kind of like this idea. Let's go 50 on our short and let's go 200 on our long. And I'm going to start with the simple. Now, you remember, we started with simple before. Simple moving average is just a mathematical construct. We're going to do simple and exponential here. And this is sometimes referred to as the golden cross / death cross strategy. And I'm just going to do it that way, right? So we go long entry, which is the fast moving from below to above. So 50 moving from below to above the 200 is our open signal. And the opposite is our closing signal. We're going to click on OK and apply and OK. And so now this is Disney once again, sideways trending stock. This is, for data purposes here, Disney. This is the 50-200 SMA. And we'll see what we get here if we run the report. And I'm guessing that we're going to have a lot less trades. We're going to have 4 trades here. And in fact, we lost. So we'll put this in parentheses, 3,178 parentheses. All right. Now let's try. Let's close that and let's just do the next level in our investigation here. I'm going to hide that 10-period. I'm going to put on here in our gear icon. We'll make this exponential. Click on OK, apply OK. And we're going to right click, run the report. And what did we get by going to an exponential moving average here? We scroll down. We had 2 trades, and it is 5,200 EMA. And we lost, in this case, in this back testing, 3,247. Wow. Okay. That tells us something, doesn't it? It tells us that this is probably too slow. So I'm going to do one more thing. I'm going to change the symbol. Let's go to GE, which was our trending signal, right? That was our trending signal. And we'll start with, because we've already got our EMAs up here, we don't have in this time frame any entries. So that's a possibility too. If we slow the signal down too far, we don't get an entry. So you got to then adjust it a little bit here. If we change this to an exponential, that is the exponential. If we change this to a simple, click on OK and apply and OK, we still don't get an entry. So that's another thing that this can tell us. In a trending stock, that may not give us an entry at all. So maybe we need to change the timeframes. So do you see the construct that we've built here? I've given you the framework for how you can go through and test different constructs of technical indicators. Now you do it. Let me just reiterate how you do this. We go to the flask icon at the top of the chart. And instead of going over here to studies, you go to strategies, and we're going to add one of those strategies. Now, the cool thing is you can put on here your own strategies that you've built. You can build your own strategies. You can adapt these strategies. You can edit these strategies, because if you come right here to that little scroll icon and you click on that scroll icon, here's the code for that particular strategy. And for those of you who are already involved in Think Scripting, here's what adds this and creates it as a strategy, right? Josh, to answer your specific question, I'm glad you added it. If you put in these snippets of code, add order, and then you define what that order type is, that's where you're going to now have that ability to back test your own strategy. And you can build it as a strategy to begin with, or you can build it as a study and then turn a study into a strategy. So the idea being, in answering that question that comes up commonly, what is the best strategy? I'm going to first of all tell you there isn't one. Second, I'm going to tell you, if you think there is, go test it and prove it, right? Prove that it is the best strategy, because don't we deserve the best? All right, let's do this. Let's pop over here really quickly, and I'm going to show you some resources. So to learn more about our upcoming webcast calendar, you can come here to schwab.com/coaching. But what I'm going to take you to right now is I'm going to take you here to the Trader Talks webcasts channel. And I'm going to do this. I'm going to pop in here and I'm going to type in ThinkScript. Not ThinkScript, but ThinkScript. And Michael Fairborn teaches, and in fact, we'll be teaching it this afternoon. The ThinkScript studies on the Thinkorswim platform, teaches that every Friday afternoon. And you can see the playlist there. And John's taught this. I've taught this. James Boyd has taught this particular webcast. So you're going to see a lot of resources there that you can use. You can build your own scripts. But if you want to learn more about that back testing idea, just type in the word back testing. Backtesting a new trade strategy, how to backtest a stock or options trading strategy, 3 tools for backtesting, strategies and backtesting, how to backtest it, right? So lots and lots and lots of resources, right? Okay. Yeah, and Chris, yes, it's not perfect. And that's why I said at the very beginning, right? Don't get caught up in the idea that it is absolutely perfect, because it is very simply a method of saying, okay, this is where we'd get in, this is where we'd get out. And you can refine it by adding additional elements to the script. But remember, it's going to function based on either closing prices or mark prices or whatever you set up. And those aren't going to be always exactly right. So this is theoretical in nature. Again, I'm going to give you that warning and disclaimer that this is theoretical in nature. It is not a guarantee. And remember, backtesting, higher performance does not guarantee future results. So some great resources. My thanks to John McNichol for helping out, and some great questions, guys, in this discussion. Thank you for being here and for being a part of this discussion. And we appreciate you joining us in this discussion today. My thanks to, again, John McNichol, to everybody else who helped out, our great production staff who is helping out with this as well, bringing this content to you. We'll see you later this afternoon for Market Movers as we wrap up this week and we launch you into the long weekend. Thanks, everybody. Have a great day. We'll see you soon. Bye-bye.